All right, guys, it's about 10 o'clock, and so you guys know, we're obviously all here live today. Thank you guys so much for coming. Also streaming this live on the county's YouTube, where it'll be available in various social media outlets. So again, thank you guys. We're here to talk about new legislation that is going to affect, potentially, new legislation, what it does, and what we've kind of talked through as an office about our solutions to it. I think every solution we have has some pros and some cons, and it's a decision that, as we'll discuss today, normally we make valuation decisions, what's something worth, and someone else determines the rates and the levies and how the money is distributed. So we're really not supposed to be a tax policy office, in my opinion, but due to the legislature's latest bill that will go in effect for 2024 assessments, it seems impossible not to make some sort of decision on this that will have tax policy consequences, and thus we thought the best thing to do is call the stakeholders together and make sure that we are acting in everyone's best interest and that we are looking at this from all the relevant perspectives. Sometimes I can get very lost in the details, and I definitely don't want to do that today. I definitely want to focus on the issue at hand. However, I think I just want to spend just a minute on some of the background of what the law is talking about. And so just real quick, I promise I won't spend too much time on this. Basically, there's three what we would call generally accepted ways to value something. And this is, I think, something we all know. Like with respect to real estate, on some level, I think we've experienced this just as adults. A piece of real estate is generally worth what you can buy a similar piece of real estate for an income-producing property. If you boil it down to an income stream, what would someone pay for that income stream given the risks of the property, referred to as income capitalization? And then what could I just buy a similar piece of land and build a similar piece of property for? Replacement cost. And generally, in a perfect world in a test tube, those three approaches to value satisfy what they call the law of substitution. A reasonable person won't spend more on something they can afford to substitute for, and they reconcile at the same exact value, market value specifically. And so the idea of market value and being credible with respect to the three approaches to value, that's something that is from a quasi-legislative body. The Appraisal Standards Board writes a document called USPAP, or Uniform Standards for Appraisals, and they talk about how to be credible on those three approaches to value. I can send out a lot of the documentation. I don't want to really get into the rule itself, but it does describe, with replacement cost, looking at what it costs to build something in your market is the key to being credible, according to USPAP. And that's important when we get into the actual law that's been written, because it modifies one of the approaches in a way that is detrimental. But anyway, I think the important thing to know is just that there's three ways to value property. They all generally arrive at the same value. And ideally, they would be identical. Okay, so we are a market value system where the assessments are generally reflective of market value. And there's all sort of testing we do with our state oversight agencies to determine, make sure we are at market value. We used to be a replacement cost state, where the assessor was given a cost table by the Department of Local Government Finance. His predecessor at the time was called the State Board of Tax Commissioners. You would describe the property on the cost table. It would spit out a value. That would be your assessment. In the late 80s and early 90s, people started suing the State Board of Tax Commissioners, claiming this was unconstitutional because those cost tables derived very different values for different types of properties in accordance with their wealth. And a lot of the evidence presented at this litigation was examples of someone's estate that was valued by an appraiser at $500,000 but assessed for $100,000. An apartment building, similarly, Professor DeBoer from Purdue added a lot of evidence in much of these hearings. He would do studies to show industrial property is this % of market value, commercial property, residential property, agricultural property, and they were all over the place. Nothing was assessed at an equitable portion of its wealth. and they made some really great arguments that made their way to the Supreme Court. Hundreds of lawsuits were combined into a handful of lawsuits that's generally called the St. John litigation. The Indiana tax court was pretty adamant that the values had to be market-driven. The values constitutionally had to be wealth-derived. The Supreme Court kind of disagreed with many of the tax court's tenets, but agreed with some of theirs. In preparation for this and getting my head straight around this new law, I spent a lot of time researching the St. John litigation. I invited various attorneys from the DLJF and county here. Thank you, Matt, for attending. And this is something that, I think definitely gets very convoluted. But this is the best snippet I could find from the Supreme Court describing what, in their mind, should happen. But basically what they're saying is we agree. I was going to bold or highlight the important parts, but this is all pretty meaningful. They're basically saying we agree that of the determination that the existing cost schedules lack meaningful reference to property wealth, resulting in significant deviations from uniformity and equality, violate the property taxation clause of the Indiana Constitution. They're basically saying you have this cost table that puts out values all over the place. It's not constitutional. People are constitutionally entitled to fair and equitable assessments, and demonstrably that's not what we have. But then they went on to disagree with some of the tax court's findings as well. It does not require consideration of all property wealth evidence in individual assessments or appeals therefrom. It does not mandate the use of strict market value or the use of 3 measurement standards. It does not prohibit different assessment methodologies for different property classifications or assessments based on value in use, provided that the result is substantial uniformity and equity. And I think this is very important to understand what the Supreme Court was saying when they said to the legislature, you need to get rid of these cost tables and you need to build a system that is constitutional. That's where the market value system of 2001 comes from. It's a direct result of the Supreme Court saying to the legislature, you got to scrap it and start over. And so we're 20 years into this market value experiment. And one of the reasons I called this meeting is it's starting to show some severe cracks to where we're getting back to the circumstances that facilitated and necessitated this litigation. But again, this is dozens and dozens of hearings consolidated and heard throughout the tax court and Supreme Court. And so there's St. John and St. John 2. There's a lot here, and this is really just the heart, what I think is the heart of the issue as written by the Supreme Court in the late 90s. So here we are 20 years later. Have we done it? Have we achieved market value to begin with? Because part of today is this law is a deviation from market value, but as a state, have we accomplished it? I think one thing frustrating for us is there's not a statewide answer. I think the statewide answer is no, but individual counties might be more close than others. This is from opensourceassessing.com, which is a website that my office maintains to basically keep tabs on this very question. Where are we in the market value experiment? This chart is based on ratio studies, which is the document we give to the state to show if we are market value or not. It's the ratio between assessed value and sale prices of every valid transaction that's happened in the prior year. What this shows is from all 92 counties, the percentages of sales that the Department of Local Government Finance deemed valid that were used to compute assessments. So think back to a market value system, right? If there's 100 sales in a market value system, how many of those sales should reflect the value of the assessments, the property value, before you can't really call it market anymore? And so what this shows is that we're all over the place. No contract versus contract means whether the county performs valuations themselves or hires someone to do it. But across the board, what we're showing here is these percentages are the percentages of sales used. The bulk of counties are like in the 40 to 60% range, meaning we are market value if you delete half the data. But guess what happens when you put the deleted data back in? Like, we're not market value in that county. Some counties are using up to 80%. Some are using downwards of like 16. Again, this is from 2019, but this situation has persisted prior to and to today as well. And so there's a severe lack of uniformity. not every county is the same percentage of market value as other counties. And the big difference is how populated you are. It's very difficult to incorporate market value principles in a 10,000 parcel agricultural community that has no commercial property versus something like Marion County that is like pushing on 400,000 parcels and a huge commercial industrial tax base and everything in between, including us. So one of the issues that the state is having is that they're trying to create a single policy for a huge diversity of situations, a huge diversity of physical parcel arrangements, and then also percentages of market value. We don't have a system of market value. We have a system of 92 counties transitioning to market value very slowly in a process that has taken 20 years and not made it very far. If you look online at our ratio studies, all of them show we are at market value, plus or minus 10%, a very tight range of values, including Tippecanoe. However, you look at the percentages of sales that's based on, and you clearly can't compare these documents. Tippecanoe is consistently in the top 5. We're always using as many sales as we can. We're about high 70s, low 80s every year. For us, it's very frustrating because we're close to market value, and this law is very impactful on people at market value. There's other communities that will not be impacted because we're at the top line of the bill contract bar today, which it makes us particularly poorly situated to handle this legislation. Okay, so lowest of the 3, I started here in 2008, and at that time there was a lowest of the 3 law on the book for apartment. As long as I've been here as an employee, as an elected official, that's always been on the books. This lowest of the 3 thing is not new. There's all sorts of ways to subsidize a market value assessment for people that need it. The most common ways are like exemptions and deductions. People who live in their house have a homestead. You're over 65, you can qualify for a deduction. You know, you're a religious organization, you can get an exemption, a whole exemption, or scientific or charitable. That's stuff that is very transparent. There's board hearings, there's a paper trail. You know, you can go on Beacon, you can see who gets the charitable exemption, it's listed right there. You can look on someone's tax bill that's all posted online. You can see the over 65 deduction, you know, all the deductions they receive. There's another form of subsidy that is totally opaque, that no one knows about. It's valuation subsidy. It's taking a market value system and then making some parts of it non-market in a way no one really knows. So by the time it gets to the auditor to apply exemptions, deductions, all that stuff, it's already been subsidized out of the public eye. I'm not saying, I think that's an unethical practice. There's nothing necessarily illegal or unconstitutional about it. It depends on the type of valuation subsidy and how it's written. The way it is currently written and has been in place for a very long time is here. I put on the screen. So it talks about the 3 approaches to value, and it talks about generally how you derive them. And those descriptions of how you derive them mimic USPAT. They're basically taking the 3 approaches, and when you say you can use one of the 3 approaches that is generally accepted, and you will use generally accepted principles to derive it, I don't think there's anything really wrong with that. I don't think that's what the judges were calling unconstitutional in the St. John case, because you can still say, I've set the market value of the property. And in reality, or I'm sorry, in academia, all 3 approaches reconcile at the same hypothetical market value. In practice, you have a huge array of data for different types of property. Some types of property, you might have tons of rental data because it's an apartment. But then other types, like a big box, like a Meijer, a new big box, there are no big box rents because they're all built to suite. Some property types do not have complete data sets to competently do all 3 approaches for every property type. Here, for example, they talk about the cost approach. Estimates of losses in value that have taken place to wear and tear, design, neighborhood influence, basically saying make sure you include depreciation. When we go about doing this, there is a real benefit to being valued on the lowest of the 3. Just because they hypothetically reconcile doesn't mean these laws are meaningless. We just engaged in a fairly large project to value all campus apartments. We got very different results from the cost approach, the income approach, and the sales comparison approach. The sales comparison approach being drastically the highest due to the cap rate some people pay. When we look at the use of the property, we use a higher cap rate and derive a lower value. We're talking about the differences between the average unit on campus being assessed for about $150,000 per unit in an apartment over 5 units on the income capitalization approach versus a transactional value closer to $180,000 a unit. But there's this type of lowest of the three requirement exists for self-storage facilities, mini warehouses. We do not feel there's anything unconstitutional about that because all three approaches can derive a market value. We are able to reconcile them. We're able to pick and choose and use research and science to determine which of the approaches, what inputs we're going to put in the approaches and reconcile the outputs. So the lowest of the three gives someone the benefit of the doubt based on the preponderance of evidence available for those property types. If one approach is coming out a little lower based on the evidence available, there is a benefit to it. In apartments, there's actually a pretty large benefit to it. For anyone who's cruising along at home on YouTube and following the links to this stuff, that's where it is. All those numbers I just shot off about the difference between the approaches, various appraisals for benchmark properties, like 4 appraisals on here. There's market studies for cap rates. We put a lot of information into finding out what the market value of these was worth. Okay, so this law was changed. Here's how it was changed. The 3 approaches to value are still required, but there's a very important sentence that changes the application drastically, and I think why we're all here today, and it's highlighted. The assessor shall use the department cost schedules without modifiers, adjustments, or other trending factors. So let's get back to that St. John case, and we'll work our way back here. But when we were that cost table that the State Board of Tax Commissioners gave us to value every property, and when the Supreme Court said this is unconstitutional, you will use market system, the way they accomplished that was by forcing every single person in Indiana to report a real estate transaction for money to the assessor's office. That's where the sales disclosure comes from. So everyone's giving us their sale data, and now we're tasked with calibrating those same cost tables with sales. Instead of rebuilding the whole system, they added a market factor. So we can take that cost that was deemed unconstitutional and apply a factor based on what's selling in the market to achieve market value and comply with the equity clause of the Constitution. That factor is widely known as a trending factor. And for those of us who have been covering this for a long time, in the early 2000s when trending factors came out and everyone's values went up and there was protest, so that's basically the tool assessors generally use to achieve market value, but we're not required to. It's an easy method for us to use because the DLGF gives us the tools to do it. There's nothing to say we can't go off and find our own tools, get our own cost tables or build our own income capitalization tables or use a completely different methodology for the most part. But this one is very limiting. It's saying you will use a specific cost table, specifically the cost table that was so inaccurate it was previously deemed unconstitutional, and you will not apply those factors that the Supreme Court held needed to be applied to maintain constitutional compliance. Basically saying you will not value these at their market value. You will value these at the table cost, and you will not mess with those costs. You will not reconcile them. You will not add other factors. You will not trend them with sales. That value is now the assessed value, which is back to where we were in the 90s, but only for one property type. Only for, as it said here, you have to have more than, I'm sorry, it's on the previous slide. Let me go back. It has to be residential accommodations for periods of 30 days or more has more than 4 units. So that's who this applies to. More than 4 units, so 5 or more residential rental properties. So, so there's a major fairness thing, right? Everyone's market value, but not these apartments. They're going to be subsidized. There's many ways to subsidize. Again, the valuation subsidy is the one that usually sneaks in and catches people by surprise because there's no way to until you really get into the weeds of what these tables put out, there's no way to know what's going to happen. I guess I'll also say this, those protests from those trending factors were met with the state legislature meeting and imposing, to mitigate property taxes, at the time legal, but now constitutional rate caps, circuit breaker caps. Apartments are given a preferential circuit breaker cap of 2%, whereas other commercial industrial property is capped at 3%. So there is already a constitutional mechanism to subsidize and keep lower the rates of taxation for apartments. This goes beyond that. These are links to two solutions that we proposed. And let me take a minute just to transition to those. Okay. So the first thing we did when we realized that we were going to actually have to use cost from the DLGF's cost table, one of our first instincts was, well, why do we have to use that cost table? Or the DLGF, just so you know, they don't have their own cost table. They don't make their own cost table. The department's cost schedule is somewhat of a broad concept. They don't have the expertise, and it's quite a task to make one that ties into our computer system. It's a very technical process. They buy cost data from a major costing firm. There's basically three major costing firms, Marshall & Swift, Craftsman, and Gordon. They buy Craftsman data, and it's a vendor-driven product that they supply to us. Well, if a vendor-driven product supplied with national costing data is the department's cost schedule, can't we use a better product? One that isn't rooted in the 1970s, one that produces relevant modern cost that reconciles with other approaches, resulted in us doing many case studies on comparing another tool using Craftsman data, more cost online, Marshall & Swift in some small cases, and then another cost tool called Gordon, RS Means is a product by Gordon Cost Services. And we looked at factories, we looked at retail, we looked at offices, fast food, and of course we looked at apartments and mixed-use buildings on campus, given this legislation. And I'm not going to spend a ton of time rehashing what we presented to the DLGF. Their original thing was we don't have money to buy better cost products for all 92 counties. We took the initiative, cost out what it would cost to get us better cost. That is way too many saying the word cost consecutively. But it's very affordable. We were able to afford it. We offered to buy the better cost table if they would sanction it as the departments. They just never replied to us. And I'm not going to go through this. And it was a meeting with various other assessors reverberating in similar size county, Allen County, Bartholomew County, that similar deficiencies with the cost table were present in their counties as well. But basically, this is just kind of showing three costs: RS, union versus open, open shop versus union contractors. This is what this is non-count. This is what it would cost to replace that building. They're between 70 and 75 million, closer to 80 million for more cost online. This is no depreciation. Just what would it cost to build this thing today? 600,000 square feet of heavy industrial space. We have an income value. Obviously, it's industrial space. It's But yeah, we went through and we showed them property type by property type why we needed a modern cost tool if we were going to be tasked with actually using this cost to derive values. Unfortunately, this is one of the more staggering examples and relevant to today. This is mixed-use facility on campus. And it's very kind of similar to the numbers with Nashan. You get a replacement cost value from modern systems in the $60, $70 million range. I'm sorry, this is just so you know, this is just the apartment. We're not even talking about the retail. That's a whole other problem of some fairness problem with this creates other property types. We're just talking about the apartments. This is a mixed-use building. You see something that's sold for $80 million, and you list it brand new on your cost table, and you can barely push 40. And that's a major problem. We're talking about tying your assessment to wealthy and constitutional. This is something that the tax court articulated, saying there's nothing more frustrating than wealthy people's assets being subsidized in ways that commoners are not. But that's kind of what this highlights is for apartments. If we were actually forced to start there and depreciate from there, we're going to be at 40 to 60% of what these assets are worth in a system where everyone else is paying generally what their property is worth. And I think charts like these are very telling for us. You can see where the income bar is right now. That's the current assessment for that income bar. And see how it reconciles really pretty well with these other cost implications for you to add depreciation to them. That's when I say there's really nothing unconstitutional or bad about the low of the three approaches because they reconcile. What's made it bad is that one line that says you will use that. That's it.
Eric, if this is getting recorded, you need to get a mic, a portable mic, so people at home can hear being recorded.
Good point, David. I travel a lot, and I leave the mic behind, and so I'm just going to be better about this. I'm going to stop going over there. Thank you. That being said, I'll be right back. Okay, this is one, I forget what I think it recently changed its name. It's right next to Willowbrook. It was formerly called, I think, McCormick Place. It might still be, but this is one in the shuttle bus market. It's not on campus, but we included this to show that generally the same thing is true. We're in a situation where the DLGF cost is just nowhere near other indicators, and the income value here was pretty low too. While it was in receivership, they had some issues with physicality of the property and its operation, but if we'll never get this anywhere near market, forced to use the DLGF cost tables. So sorry to jump off of there. I thought that was relevant. But basically, we've been in discussions for months with the DLGF trying to get them to approve some other form. This LCM check, LCM is a location cost modifier. Something we talked about early on with our council and the DLGF's council is if we can't add external factors to bring it to market as every other property, are there internal factors? And there are. There are internal factors that can be used to adjust county cost on the county basis. We could have our own county cost multiplier that would reconcile the differences I just described. And there's a process in the assessment manual where you submit data to the DLGF describing why you think your LCM should be higher than the one they give you by default. And so we went off and we looked at what the discrepancy is on the cost table for new home construction per their guidance. It's all based on new home construction costs and sales. That second residential LCM check, That is a map of every new home built in 2022, the sale price of what it costs to build, the cost from the table, the land values assigned, and what LCM or factor would be required to be able to use market, so that we could not apply external factors but keep our apartment values market. It shows a 95% confidence interval for the LCM is in the about 1.65 to 1.7 range, meaning to achieve cost given the current cost tables, your new home would need about a 70% factor above cost to get there. We requested a 39% LCM increase to attempt to bridge the gap based on a handful of reported costs and their recommendation to ignore the sales and use what builders were telling us instead. They rejected both methodologies, even though we feel that we were trying our best to adhere to what they were telling us to do. Explained to us that they would not allow us the internal factors to bridge the gap. And that's when I called this meeting, saying we laid out two good paths that we thought we were willing to do all the work, put in all the time and effort and money into maintaining market value. We just need their blessing, and they did not give that to us. So that's when I was like, well, we're going to have to do something else that is not nearly as clean as these solutions, and that's the heart of what we're going to get to today. I am still setting you guys up to have the information to vet the solutions we'll present. Yeah, that res LCM check, you can scroll all over, you can see there is no part of the county that these cost tables for residential property are even close or in the ballpark. This is just, before we get to the solutions, I thought this was just, we'll play a game. Guess that AV. This is the Fuse building. I don't know if you're familiar with Fuse. On campus right across from Mackey. It's a mixed-use facility. In 2016, it sold for $80 million to an REIT. Typically, those buildings are investment-grade property, and the only real buyer is an REIT. There's no local people spending $80 million on mixed-use facilities. We assessed it last year for $67.3 million based on the lowest of the three approaches to value, being income capitalization. Anyone want to guess what the DLGF cost table would put this at? Too high. Too low. 39. So anyway, but yeah, and this is really, when you look at the property inventory of campus, or just walk around campus and look up, I mean, think of all these massive structures that we just built and allocated TIF money to build, just getting tanked by about 40 to 60%. It's doesn't make a lot of sense in a market system. Okay. Sorry, I lost my mouse. Okay, before we get into solutions, I want to talk about a few other, those obviously that it's way too low and using it causes disparity. There's some other equity problems with this. Something that we're not thinking of is, think about downtown Lafayette. There's a lot of mixed-use buildings and a lot of converted houses. Many of those converted houses are 4 units. Many are 5 units. Remember, this only pertains to 5 or more units. Think of just the nonsense of a 4 unit next to a 5 unit of similar property types. One's going up 5% next year because it's got 4 units, or it's a duplex, or it's a single family home, but the 5 unit is going to get chopped in half. I mean, and they're pretty similar physically. They're on the same street in the same taxing district. I mean, that's the result of having this regressive policy of this is only going to pertain to people who have more than 5 units in a building. And for those of you, a regressive tax policy is one that favors the rich over the poor, in generally speaking. You know, one that's saying if you have a single family house, a duplex, a 3 unit, a 4 unit, your market value. But once you hit that 5 unit threshold, there's an arbitrary table where you get a very low value from. And so that, from just a common sense standpoint, that I think that gets back to what the St. John case was about. Just things that are obvious. It doesn't need a lot of math to show that, you know, these properties are similar enough. One shouldn't go down 50% while one goes up 10%. Like, that's fairly absurd. The other problem is, like we talked about Hub and Fuse and Rise, and these are mixed-use buildings with offices, retail, and apartments on a single parcel. it's not really clear to us when you start mandating methodology for apartments, what about the uses that are still held at market value but are physically attached to those uses? When you start using other methodologies to value parts of the building, you end up with double accounting for land in some cases. Like if you were to use income or sales to value the retail, you would value the land as well. So then do you not value the land for the apartments, or do you value the whole thing on replacement cost, including the retail? There's a lot of equity questions and logistical questions the DLGF has not answered that really make the law almost impossible to apply without dragging into it everything that is attached with it. And then if you do that, you get back to the first example, it seems wildly unfair to have, like a fast food restaurant on campus being assessed by some low-cost table because there's apartments above it, while the restaurant XXX across the street is getting hammered because they don't have a bunch of apartments above it. And so you have to find some way to separate them, which creates many logistical problems with reporting and maintaining values and breaking them down between land and improvements when multiple methodologies are capturing the land. How do you separate, or how do you allocate a land value to the replacement cost of the improvements when you're also valuing it with the retail or office or parking? So logistically, it's not even really applicable for mixed-use property in any sort of consistent way with any other types of property. And this really is problematic because we have so many high assessed value properties that we're talking about tanking. But this isn't the first time that we feel the Constitution has been trampled for one property type or the other. Other things are golf courses and agricultural land, which also are valuation subsidies that are very detached from the realities of valuing property. I think most people with ag land realize that if you tax farmers into the ground, your trip to the grocery store is going to be pretty awful. So I think most people understand the societal need to subsidize ag. Personally, I think wish it was done differently, but it's never really been the same sort of drastic one-year problem with ag. And there's so few golf courses that I think that the fact that they have a very chopped up beneficial law doesn't have the same community-wide fiscal impact, and just hasn't been a big thing on our radar to call a meeting like this. But so these are some equity problems that this creates in addition. Okay, so let's talk about the reason why we're all here. What are we going to do about it, right? This is kind of why I wanted to get the stakeholders, the people whose money it is, who are going to get, have their organizations potentially affected by this. I think there's many options. So this is the first one. This is the one that I think is pretty much the most understandable. Do what the law says. Tank the apartments. Meanwhile, everyone else gets hammered with market value. I think the biggest con here is it's clearly regressive, and based on my understanding of what the St. John Supreme Court cases were, doesn't seem constitutional. Seems to put us right back there to St. John, where there's multiple definitions of value for different types of people. And so yeah, this to me is a good solution, because for all those people with budgets, this limits the damage to apartments. It's not a good solution. There's between like $600 or $700 million of a couple $1 billion of total apartment values that will be lost to this. Focused specifically around downtown Lafayette and downtown West Lafayette particularly will be much more affected. I mean, like Jackson Township is not going to have a problem with this. They don't have any apartments with more than 4 units, but there's a couple taxing districts that this will be felt much worse than others. And so yeah, this is the kind of like most basic solution, and it's not really a solution, but action we can take. I think what this does is sets the ground for St. John 2.0. If we were to accomplish this, I think every single person in this room, in this county, who owns a home or a retail business or a restaurant or a hotel has a great grounds to basically sue the DLGF again, or engage in similar litigation as St. John and say, I'm being assessed at my market value. I'm fine with that. That's what the laws say. But there's many people in my community who aren't, who are being subsidized unconstitutionally, and I'm picking up their burden, and I don't think it's fair. And I think this solution sets the groundwork for that. And talking to many of my colleagues, they're of the same mindset, that we have come full circle in 20 years. And if this is the action plan, then it will be superseded by a lot of litigation that we've already litigated, or has been a major focus of Indiana's property tax system, is the litigation that got us to here. So yeah, this one, this isn't our favorite one, unless there's a lot of people in the community who are willing to pick up the legal fight to eventually have our actions overturned for the future. But I think that those two things would ideally go hand in hand. And just, we'll have a nice healthy Q&A and discussion. I wanted to get through these last couple cases about if you guys have opinions or ideas that we're not seeing. This is one that we kind of call burn it all down. Whereas when we think back to that chart of percentages of sales used, because you can use however many sales you want to use as long as you seemingly use more than the 35% minimum, that creates a huge band of where you can set values from high to low. One thing to do would be figure out the percentage of market value we're assessing apartments and decrease everyone's assessment by that factor, creating fairness. The burdens won't shift because our new definition of market value will basically be derived from an arbitrary low table. Everyone's assessments will be arbitrarily low. The rates can't only compensate so much, and a lot of revenue would probably be lost to the caps. This is the most fair one, in my opinion, for the people. The poor don't inherit the rich's tax burdens they don't want to pay. But it also seems like it's maximum damage to fiscal districts, to the school districts, to the county government, city government, the police forces, to fire. All the organizations that keep us safe would be the most affected in this scenario. And for that reason, it's not a great solution. One more. Here's the three that we thought we could pull off. The other thing is, there are inputs to the cost system, architectural grading and stuff. It is possible to grade these in such a way that we can achieve what we feel is market value. With the way the law is written, the assessor's office has a legal burden of proof in proving in litigation that these determinations are correct. I don't know we'd be able to do that. To me, this is least damage to rolling 2024 values. Our 2024 values will be very similar to our 2023 values, be as if this meeting never happened. The problem is, as people start appealing this, and our docket gets huge of cases that we don't have great defenses in, and we have the burden of proof in proving we're right, it could be the eventuality as we slowly bleed back to cost after expending huge litigation fees and time. So this is the best solution right now. I'm not confident that this will hold up long term. In looking at several prominent tax attorneys and tax reps' websites, most of them have articles about this and are gearing up to file tons of appeals on counties that do not proactively try to adhere to this. So I think they can make some good counter arguments if we choose option 3. I think we could have a healthy debate in front of a judge. I just don't know how that's going to go. Unfortunately, those are our 3 options, and none of them are good. And that's where we are, and that's why we called this meeting, is because I don't want to do any of them, but I think I have to do one. So with that, I know that was a lot. I tried to limit the details to what was just relevant to this law and what we're tasked with. Just to give you our time frame, all of our 2024 values must be submitted to the Department of Local Government Finance and Legislative Services Agency by March 1st. We need every bit of February to calculate values, and we need to know where we're going to start. And that's why the DLGF telling us days ago that there would be no oversight solution to this put us in, hey, call a meeting right now because we need to know what to do for the next month to set values. Does anyone have an opinion? Scott, do you want to come talk? I can repeat it if it's short. I don't know.
Yeah, is there a reason why the DLGF did not want to approve your cost tables?
So Scott's question was, did the deal just give us like a reason why they denied our cost table proposal? So we made two proposals to them. The one I showed you was from our let us buy a better cost table, you sanction it, we comply with the law and push forward with market values. That was when we had like a coalition of similar assessors and similar situations that we pitched the DLGF. They had a lot of questions about implementation. They just never responded. They didn't say no, they didn't say yes. It's a passive aggressive no when we would have had to implement that solution about a month ago. They just let the time expire, never said anything or replied to requests for updates. So that was a passive aggressive no. I have no idea why they would be, to me, if I had to guess, you know, that's their cost table, I guess. Maybe it could be an ego thing, like we don't want to let, but it's all vendors' software anyway. So I really don't know why that wasn't a viable solution. The manual that expressly tells you how to calculate an LCM, a location cost multiplier, that internal factor. There's a whole DLGF process for that. They've approved those in the past one time. They did give me reasons why they would not approve ours. They said they had concerns with it. It would be, we're the only county of 92 who requested it. And if left to their own devices, they give you an LCM between 0.92 and 1. So they only use it to decrease certain counties below 100% of cost. I asked for it to be 0.39 based on research that says it really should be about 0.6 to 0.7. The reasons they gave us were they're concerned about the data pool. I would say I believe a big portion of this group, at least the people in county government, I've sent my reply to, and I'm happy to send it to. There is a back and forth discussion over why or why not that should be approved that I think actually does a better job than me summarizing it. I'll make that accessible because I guess I'll summarize it by saying I don't think they have pointed to a valid reason, although they have said some words that I disagree with and have articulated in writing better. Does anyone have an opinion about what they would like to see happen? Or does anyone, yeah, Lisa?
I have a couple of questions. What do we think the impact dollar-wise is going to be to, let's say, the county or our budget? And then also, what are other counties doing? What are they looking at?
So to the question, what are other counties doing? I've talked to a lot of my contemporaries, and many of them are waiting to see what happens to the request from Tippecanoe. And now they're in the same boat we are, as in scrambling to figure out what they're going to do in the next month. Many counties doesn't affect. Like I said, they have millions of dollars, not billions of dollars, in apartments with more than 4 units. So they're looking at this as, oh man, what am I going to do for the 1 or 2 record cards I have to modify? It's not a huge deal for a lot of people. And then there are some populated counties that do have a lot of apartments, but have never actually made the change to market value and have been using this cost table the whole time to value their apartments, and this law constitutes no meaningful change from what they've already been doing. So because we're not all in the same starting point, we're all reacting differently, and we are in the worst place to deal with this because we are so close to market value. We have the furthest to fall. The other question, what is like the actual tax implication of doing this? I don't think necessarily she could answer it today. Jennifer is here, and I did invite Yadira. I feel like I'm raising the alarm that I'm going to tank the values. I'm probably not the best person to answer like what actual taxes repercussions will happen. I feel like just given the magnitude of the assessment decreases, and especially on Purdue's campus, I feel like it's bad. But beyond that, I can't say like it's $10 million for TSC or something. You know, I just don't know that part of it. And a lot of it will be based on what we decide today. Like if we decide to go with option 3 and we decide to overgrade these a little bit and maintain our current values, I think the impact will be 0 today. But then once this gets litigated, who knows? That one's very hard to answer. But like, I think we could probably work with the auditor and a list of parcels I know that's the big question that I've received so far. That's something that we probably should work with the auditor to have a better idea of if we're going to do one solution over the other, what does that mean? Yeah, I'm really just raising the red flag that values are going to tank, and I think it's going to be bad, but I don't really have the exact number for that. Yeah.
Okay, I may be wrong, but I thought that if appeals
I don't believe so. And so I think the you guys, I don't know what from your perspective, the government, right? That's a treasurer thing where I do believe there is some legislation where if you have a pending appeal, you can pay your liability from the prior year, and maybe a differential is held till the appeal is settled. But I don't think there's anything wholesale where, like, if there's an appeal, you just don't get any. It's kind of like the IRS, like you pay what you think you owe or you owed last year. If the IRS is right, you owe what you owe plus interest. If you're right, it just goes away. But it's not the whole tax liability. You still have to pay what you would have paid last year. And because last year we're at market, in this case, I don't think that's a valid concern. I think it's something, if it goes up a lot, I don't think you have to pay on the increase until it's litigated, but you still have to pay what it was last year. So in this case, I think that's pretty moot.
Then if they win the appeal, the money would be taken back.
Well, they already would have paid what they thought they owed, so basically the excess would go away, but they wouldn't get it, but yeah. Yes? The attorney that generally represents the assessor's office, Matt Salisbury, has graced us with his presence today. Yeah, he was one of the first person I talked to about, that was one of the things like, hey, when you say we can't use external factors, or you say we have to use the department's cost tables, one of the first things we did is talk definitions with not just Matt, it was the general counsel and the deputy counsel for the DLGF as well. What do you consider the department's cost schedule? What do you consider an external factor to make sure that our solutions, we're still going to comply with the new law? I mean, we were worried about, saying we're using the department's cost table and then someone subpoenaing or getting a DLGF employee in a deposition being like, well, that's not our cost table, and then there goes our whole case. So we did engage them originally. This presentation council had nothing to do with. We've been CCing council on our conversations with the DLGF. I don't know that there are legal issues that, basically I'm hoping that, Matt, if I am way off base with my mind legally, I'm hoping Matt will be like, but.
My recommendation there was to approach other county assessors, see if there are other assessors in a similar position, to build a coalition and speak with the DLGF about the cost tables and the modification that would be done that would be in line with the statute. I think that Aaron's proposing option, correct me if I'm wrong, but the issue is that if you follow the statute to the T, which would have to be my legal recommendation,
I think that could have been the presentation, honestly. That was pretty articulate, Matt.
When Aaron says take the values, and this is a question, are you saying just you would follow the statute and you would have to follow the limitations on the apartment buildings and not seek to use any available modifiers that might still maybe be on the line between allowable or not allowable, but worth taking a chance with the goal that you just are going to achieve a market valuation that's accurate and reflective of our county valuation?
Yeah, when I say tank the values, what I'm saying is take the values based on our best knowledge of what physically exists, enter that into the cost table, take the resulting value, and use it as our assessed value, which results in tanking them from their current market levels. But I'm not talking about assigning them a lower value than would be dictated by the law and by the tables. The result is a tanking, but thank you for that. Scott?
What is the speed of this new legislation? How did it come about?
So that first slide I showed you that had the original wording of the code that dates back to 2005, the lowest of the three for apartments has been on the books without a requirement for the assessor to derive value three ways. And I think apartment owners were getting frustrated in other counties with assessors that were not willing to value the properties three ways and had some pull in the legislature and got the legislature to write a law specifically requiring the assessors to do just that and then report the value three ways on a new reporting form designed specifically for this law. And then this piece at the end where we have to use the department's cost was added at like seemingly the 11th hour, like this last addition to the bill that got pushed through. But it seems to be the result of frustrated apartment owners who don't think the assessment community has been doing their due diligence with the 2005 version of the bill.
Do our local legislators know the impact and how this new law will impact Tippecanoe County? And then I always think, what's next? I mean, if that's an opinion question to you, what could fly under the radar next?
Yeah. As far as the local legislatures, I invited them to this meeting. I don't know what they do or don't know. My experience is the legislatures locally, like all of them have their own like area of focus and things they think that are important to them. I don't know that the local folks are really power brokers when it comes to like the fiscal bills, especially the property tax stuff. I think there's probably legislators who know a lot more about this bill than the local folks and are probably the driving forces. As far as what's next, yeah, I don't know, I think like every year there's some different property that's trying to be subsidized. I think no one expected the impact of COVID on real estate values. I think the legislatures are concerned about how high some of the values are going in the market and thus the assessments for houses. I know they get a lot of feedback that year over year double-digit assessment increases aren't perceived as sustainable for a lot of homeowners. So I perceive more subsidy and more variation in the types of subsidy. Like we talked, like I think they'll rely on valuation subsidy because it doesn't show up on a tax bill. But yeah, I think that's a big concern too. Is this is a major crack, but like, what would collapse the system? Yeah. Yeah, so one of my colleagues is doing that exclusively to deal with this problem. So her question was, can you do a land study and can you increase the land values to mitigate the loss? I think that's a great instinct because the replacement cost system of value is the land as if it was vacant plus the depreciated cost of all the improvements. Typically the land will account for about 20% of the value. On campus it's probably more than that. So that's a great instinct, and one of our first instincts was if we're going to use this and we haven't looked at the inputs to it for a while, let's look at all the inputs. Vacant land is its own classification on the ratio study. So we have to be able to show, independent of apartments, that vacant land is assessed for what vacant land would sell for. But to answer your question directly, yes, that was one of the first things we did is we did a land study. We made a map of what the new land values are, and I can forward that to you because I think minimizing the impact, it does play into that. I mean, our land study showed an increase of about $300 million for just the apartment land after doing the land study. And then with grading, there's another internal factor that you can basically undo the law through grading and land valuation. I just don't know. The land, we had to stop at what they were, because we actually have some transactions, some tear down transactions on campus, the whole 52 bypass. We had a surprising amount of vacant land study. So we did push our land up to those limits of contemporary sale levels, but going beyond that creates an undefensible situation for the folks that actually just have some piece of vacant dirt. It's fine for the apartments, but, so there's a balance there. But that is a great question. And yeah, if you want to provide me your email, I'd be happy to send you a map of what those land values look like. Jennifer?
What are you seeing with other classes of property as far as any upward, downward, maybe personal property?
I don't have a good read on the personal yet. We're still collecting that. I would say generally, most other classes of property would show a somewhere between a not the same kind of double-digit increases we've had in the last few years, but more regimented increase, more normal, I guess, market activity where days on market seem to be increasing. I think there has been a legitimate impact of higher interest rates, but it seems to be in the form of days on market and we're not seeing like declines in sale prices, especially for residential stuff, is holding its own. So I would assume the general answer to that is like some sort of minor ticking up across the board.
Because the net value that would impact the rates and the dollar, would be driven by that
Mhm.
overall. And that if it stays pretty neutral, the net value, then that's where you see the shift of the burden tax to the residential or those other things.
Yeah, we were trying to figure out, and we can work on this later, but like we were thinking about this from the terms of like the caps, whereas if you live in your house, it's homesteaded, you're at a 1% cap. So there's a big, and there's also a deduction associated with that of assessed value. So when you think about like the difference between gross assessed value and net assessed value on like a $200,000 house with a homestead, it's huge. There's a huge difference. The same cannot be said for apartments, whereas there are some apartments that are just exempt and they have no net value because it's like owned by Purdue or they're in a leasing system with Purdue. But other than that, like dollar for dollar, there's really no net gross difference between apartments, and they're taxed up to twice the rate, which for downtown Lafayette, West Lafayette would have a higher rate. So yeah, one thing we think about too is like the impact of apartments is greater than dollar for dollar those of houses. But yeah, and I agree with that. Like because we live in a healthy community that is growing, there will be new construction and appreciation from other property types that we can legally capture and increase to net assessed value that can help compensate this. Part of it gets back to the fairness. It just seems so wildly unfair to take these or literally talking about the tax burdens associated with assessing apartments for way less than market value and talking about how we're going to recapture those for the houses. Like how is the average person going to pick up the tax burden for these apartment owners? And although, yeah, there definitely are solutions we talked about today that would maximize keeping that revenue intact, that's the hard part. And the part that as an assessor I'd rather be detached from than be at the center of. Yes?
Have you modeled yet the approximate impact on the county and municipalities of Solution 1, 2, and 3?
No. Yeah. I feel like goes without saying, just the timing of this, we're really way behind where we should be. We were really putting all of our eggs in the DLGF will provide a viable solution to this. And so no, I wish I realized that would be very helpful in determining which path, knowing exactly how much. Yes?
So knowing the challenges that could come as a result of number 3, because number 3 gave you good time then to build a case moving forward since time is of the essence.
Well, my concern is not so much the time of building the case, it's can the case be built? It's the content of the case. I don't know that any amount of time will allow us to defend the grades we would need to maintain the values. The grading charts that were given in association with this cost table for commercial industrial property are very vague and broad. Like the difference between like an A and a B could be, are the materials good versus great? Like it doesn't say like this is hardy plank and this is vinyl, or this is steel and this is fireproof steel. It's like good versus great, above average versus high quality, you know what I mean? So I think we can make some arguments, but I think part of it is going to be pretty obvious looking at the records we have online that we made a real effort to change the inputs to comply with this. And if I was the opposing counsel, I feel like I would have some good arguments to make as well. The thing is not so much the time as just the validity of it. And when we say, you know, pursue legal change, that's one of the reasons I got all you guys here is I really don't know where the local legislators are at. I'm not the type of person who really tries to meddle too much in the legislative session. I seldom write opinions or try to lobby. I think that's more of a question for the group is this law, are we all complicit in it? Is it going to be in perpetuity? Is it going to stand? Because that kind of, is there any desire or contacts in the community to have a discussion about what the intent was behind this law and if this was a legitimate impact or there's modifications?
So then, doing this could buy your particular professional organization to lobby and make change to the legislative body.
Yep, that's you know what, I called it a con. You know, might be kicking the can down the road, but it's not a con if in that time we've kicked the can down the road, there's changes and clarifications that by the time we're time to litigate the can, it's a very different can. So, yeah, this was kind of like the let's stall for a bit because it's going to take them a minute to file the appeals, you know, have all the depositions, get hearing, they'll have to get denied, have our informals get denied at the local board. This is going to be a long time before a real judge is sitting before like two well-compiled, thought-out cases. And there is a substantial amount of, hopefully, things that could happen there, but that I just don't have the connections, the mechanism, the lobbying expertise to make that happen, which is another reason why I thought getting this group together would be a good test to see if that's a possibility. You guys know any lawmakers who are sympathetic to the county and fairness? And I mean, I think I'd be a little bit naive to think that someone was going to raise their hand and be like, it's option 2, let's do it. You know, today anyway, but we do have to, like really starting next week in earnest, make some decisions that we'll have to carry through to March 1st. And so I'm happy to continue this discussion with any of you or anybody, but yeah, the next 48 hours or the end of the week is really going to be, we'll have to figure out 2024 values.
So what do you mean? You have 48 hours, you gotta be heading down one at a time.
Well, so I guess the hard part is that, you know, running everything from this cost table and having an equitable loss of value, I think is really not wise without knowing the fiscal impact, but from being assessor and being really concerned about value only, and that I'm personally more concerned about fairness than accuracy, and that's why, honestly, solution 2, where everything is decreased equitably, is the most fair for the regular person at the expense of everything the people in this room do. I still think it's the most fair if there's not going to, if we're complicit in the functional end of market value as we understand it, and accepting a definition of market value that could include things like tables that, you know, yeah, I feel like the, you know, setting us up for St. John 2.0 with solution 1 is only a good path if there's people willing to take up that cause, if we're actually going to go down that route. I personally am more confident in how similar this is to the last time than maybe Matt is, but Matt's also an experienced attorney and I'm certainly not, so there's that.
Yeah. You have a statute that provides some real limitations on how you do your job, but you have to follow the statute. So you work within the statutes to achieve the closest thing to the market value. You're just trying to get an accurate valuation. So my legal recommendation is not to inflate or deflate artificially anything beyond just find a reflection of the market value. The problem
So I think that's both good points. It sounds like more leaning towards solution 3 within that. To your second point, I do want to point this out when we talk about the law, because you're right. You're absolutely right about your comment about the law that we put up here. It doesn't mention the other property types. Without getting too much into what other counties are doing with that cost table and proxy, I want to talk about this part here. I actually bugged Matt about this, this wording. It says, notwithstanding some code, and then it tells us to do this, right? The part that it's saying notwithstanding was the code that was inserted after St. John that says the DLGF will make an equitable system. So they're saying like, so there is a law that says taxes will be equitable. And to achieve this, the law also says to ignore that law. And so it's like, it doesn't seem possible to follow this law without ignoring that law, which it specifically says to do, but it's still a valid law. So I get that. Like, which law should we ignore, and what are the consequences of ignoring this versus what it says notwithstanding? But Scott? So I would say that without that, I would say regardless of what that law says, you still have the St. John litigation that created that statute. So you can always go back to that. I think that can always be relitigated, and I think it should be relitigated based on where we are now. But yeah, I think if the legislature were to delete the part that says fairness is not important, or override it and say ignore the part that mandates fairness and do this unfair thing, I think both of those put us back to St. John. I'm sorry. I'll get to you next, Brad. Go ahead. Oh, sorry. I was going to talk to her. One second, Brad. I'll get to you. Sorry.
Can you tell us the exact state codes so we can tell our state organizations, because they're currently locked in right now, so what's the exact state code that we just point them to that has this?
I will forward it to you. I don't have it memorized, but, we can, what's that? Oh, you know what? Thank you, guys. There you go. Section 39 right there. Brad, what's up?
This is more of a question maybe for Matt than for both of you. Is option 3 defensible? You mentioned, you want to do what is defensible. Is option 3 defensible?
Yeah, certainly it's defensible. You're gonna try to achieve accurate valuation, make an artificial cap at the top. That doesn't mean that there aren't other tools that might still fall within the realm of the DLGF table. I'll defer over to Eric on the expertise on what tools are available. This also lines in with the earlier question about can you challenge that line that says you can't use modifiers and trending tools? Certainly can. Oh, yeah, sorry. Yes, you can challenge that line, and I would recommend looking at options to challenge that. It's a question of how do you approach that challenge. So the GA has spoken. They've had a significant lobbying effort that put that modifier in there. It doesn't mean that it would withstand scrutiny. My concern is, or at least my concern from a county attorney standpoint of bringing that challenge just on our own, is that you have the agricultural land that survived its own sort of carve-out for a number of years. And you see, you're going to have to be able to factor that in as an opposing argument for why this would be a justifiable modifier. So when you put the ceiling on, you also have to understand the significant power that must have come into play to put that language in the first place. So you're going to have a very strong defense against any challenge. I think with option 3, as Brad had asked about, you might present yourself an ability to bring that challenge in a way that is seen through the lens of appeals. So if Eric were to bring valuations and they're challenged on an appeal, you would need to do it fairly and in a manner that's justifiable. You disagree with the valuation that would come out without any of the modifiers or trenders. You know that if you go too far, it's going to be harder to justify because the statute specifically puts the burden on the assessor to justify. But if you have a gray area where your valuation is higher than what, if you did a strict reading of no modifiers or trending tools, if your valuation is higher than what that would bring, but you have reached that valuation by using DLGF sanctioned tools. And there might be some limits that are pushed. But as long as you have a case with merits in an appeal, I think you can bring in, and within that appeal, the issues with the extra language that's been added to that statute that takes away all trending tools, because then it becomes a definition of what is a modifier and a trending tool. And then within that, you can also talk about the bigger picture of is this fair to all property owners in the St. John's case. You know, I think to bring a full challenge on based on a St. John's case as a constitutional challenge is that's a difficult case to bring from one county with limited legal budgets and other limitations. I think it's a much better case to bring if you have a coalition and if you have some sort of lobbying effort that's going to be supporting you, including with legal, support. I mean, that's not a case for a two-person legal team that represents the county to bring. It's not. You need experts. You need fiscal experts. You need tax policy experts, and you need large firm attorneys that bring that kind of knowledge, and that costs a lot of money. So I'm very much in favor of trying to bring a challenge, but I think it has to be wisely done because you don't get many bites at the apple. And if you lose a challenge, especially that's been appealed to a larger court, now you have a real situation. So I don't think that there should be no waiver of a challenge on the county's part that, oh, well, that shouldn't happen. I just think you have to get your ducks in a row. The problem is you have this year. And so that's where I think option 3 makes sense just from my own, my own standpoint. You just have to you have to make a fair assessment. You can't make an assessment that is for the purpose of an appeal or that goes way beyond because we now have a gap. It's not the assessor's job to guarantee last year's budget will be continued into this year. The assessor's job is to create fair and accurate valuations of property across all classes, but within the limitations that are put on by the GA. You have to follow the statute. Eric's in a bad position because he's going to be possibly bringing very bad news for all of the local townships and governments because the money may not be what it was in prior years because of a new clause put into a statute that takes away the tools that the cook generally has had available in the kitchen. And it's unfortunate, but I think you have to be measured in the response.
So I think that was a very well thought out, articulate justification for option 3. What do you guys think? Some nods? I'm feeling a lot leaning towards option 3 here. I respect Matt's opinion. I thought that made a lot of sense. She said 3 before she left? So there's another vote for 3?
Well, I think you've got to take option 3 and then you've got to step up what's got to be done. And number one, you've got to get your rates and your assessments done and all that kind of stuff. I understand that. But in addition to that, right off the bat, we need to start talking in terms of what our lobbying forces will be, and there are a number of them in this room. I mean, we've got a couple school representatives here. There's a lobbying force. We've got redevelopment commissions. There's a lobbying force. We've got our local municipalities. There's a lobbying force, and so we need to bring all of that to bear upon the state legislature. That's just one. 2, we've got to set ourselves up for the appeal that's going to happen legally. Because if the lobbying doesn't work, you've got to be ready to go on an appeal to have the state basically endorse the Constitution again in the St. John case and say that it needs to be equitable across all property types. And the unfortunate thing there is that there's going to be some unintended casualties along the way, and those unintended casualties may also be your agricultural land and your golf courses and whatever else happens to fall into those areas. Because if you're truly going to fight the equitable issue, you've got to fight it on all levels, and it's got to be equity across everyone. And then finally, I think, and you've started this today, is that you've got to bring this out into the realm of public opinion and allow the public to understand that, decisions are being made down at the legislature that are going to have a direct impact upon your house and what you're going to pay on your house, because if, the bottom line is that local government requires X number of dollars to operate. And it's got to come across everybody. And if it doesn't come across everybody and we're going to play favorites to one group, i.e. apartments that are 5 and more, then the other groups are going to have to pay more. And that the public should know that right off the bat, that they are the ones that are going to stand to pay more at the end of the day.
I think those 2 comments taken together are very meaningful, Matt and the gentleman's. One thing Matt said about the challenges to St. John being no small undertaking, I think the last St. John challenge started in the late 80s and including the early 2000s. And so we're talking about over a decade of litigating various cases at the tax court and Supreme Court. So I agree with that. That's no small undertaking for a couple people. As far as litigating the grades and are they defendable, I think they are defendable, but our litigation team is like me and some of these fine folks, but we're not attorneys. We have very limited budget. And so getting back to what you said is that for us, even though it's not nearly the undertaking, defending a grade appeal is not nearly the undertaking of relitigating St. John, but it is still, when we're going to have dozens of these similar appeals by better funded appellants, will be beyond the litigation scope of my office to do effectively. And so that's where it gets to, option 3 kicks the can down the road. It averts a catastrophe today. It sets up all this litigation that you mentioned we have to get ahead of, because if we're caught in the same position now in 2 years, we haven't done much good by picking option 3 today. But I mean, I think based on some of the comments and feedback that's where my head is leaving the meeting, although it might not have been coming in, is option 3. Sorry, Matt.
I think all three options have potential. Sorry. I think all three options have potential for litigation. The litigation might be coming from different groups, but option 3 puts the litigation focused on the affected groups of the property owners that have been benefited on one side, the county government and the county assessor certainly on another side. But in the other 2 options, I think your litigation is coming from other groups that didn't lobby for the bill or otherwise have a direct push to have this situation in the first place. And when I say that, I mean if you're going to lower or affect the assessments on non-apartment type properties because as a reaction to this statute, then you're going to have those interests that are going to come into play, and they might be pitted against each other. And then you have obviously the county budgets from every county in Indiana that would be greatly affected. In our county, just specifically, if you were to go with option 2, for example, and lower the assessments across the entire class of properties, which would result in not going after the market-driven approach that had otherwise been the general policy, I think you end up with a number of people and groups involved that are going to be hurt by that. You're going to have less money available for various line items in the budget, including line items that may have supported necessary mental health, any other type of need that's filled through our county governments and through the townships because of the tax money that's coming in. If that entire amount is lowered significantly beyond the $700 million that you've referenced that might be lowered because of this property classification, then you're going to have to deal with all of those various shortfalls. So I think option 2 has litigation behind it, and then option 1, you're gonna have people that are unhappy and feel that they have been shortchanged or not treated equally. Option 3 puts that focus specifically on one side, the apartment owners that have benefited from this change in the law, and on the other side, we have a situation, and we may have to litigate to address the situation. But I think that it puts that focus on the proper parties.
Appreciate that, David.
We need to sync up with those other counties. You mentioned Allen and Bartholomew. Are there others that are like us in this situation?
Perhaps, yeah. They have a lot of apartments. I think the problem is the assumption that there's a lot of similar situations like this. If the assumption is apartments are market value and they're going to this arbitrary value, but many counties start with the arbitrary value now, and going to this similar arbitrary value is literally nothing for them. So a lot of the most similar, it's that chart I showed of the percentage of the sales. If you're not at the top of the chart now, if you're not using 70, 80% of your sales and you're not deriving a market value, this really won't impact you as much. And so I think when Matt said make a coalition, put a presentation together and go to the DLGF and explain this to them, that's exactly what we did. It was a relatively small coalition. I think there was 3 other assessors on the phone, 4 of us total. But yeah, I think that those ones you mentioned, those 2 assessors are keenly aware of what's happening and would be good allies, have been good allies in helping us articulate this to the state. Like I said, the state didn't have a good reason not to let us use modern cost. They just never responded. David? Sorry.
So I'm sorry, in my teaching obligation, so I don't know whether you've addressed this already. Where did AIM stand on this when it was coming out, and has there been any communication with them since then?
pardon my ignorance, who is AIM?
Association of Indiana
Oh.
Municipalities.
Oh.
Municipalities, the county have their own group, so they don't intersect with any quite in the same way. So this
I see.
wouldn't have been on their radar through AIM, though it was on AIM's radar.
Yeah, I mean, I think we have like AIC, or Association of Indiana Counties, and the Assessors Association has a lobby. We elect one of us to lobby, and that's actually the Allen County Assessor, does a lot of our lobbying work. I think she put up a valiant effort to articulate why this was a bad plan unsuccessfully.
It does affect us as a municipality as well as the county as well. I was just curious.
My experience, and they send us out a report, a weekly report of where all the bills are, and this was one where the bill seemed very benign until it was like signed into law and included that last sentence. It seemed like it was just focused on the reporting of the different values, but not actually affecting how they were computed, and they just stuck on this one sentence. I don't know how well the sentence was vetted or if anyone realized the impact it would have beyond the person who stuck it in there. So no, I don't think that there were a lot of eyes on this. I don't think a lot of people understood what it said, what it meant, and how it would be applied. We have hard lean into option 3 here, but just, yeah, there's definitely some follow-up on the community's part if we're going to be successful in not being back here in 2 years. So, yeah, I think option 3 does create an environment where we're not like desperate, in a desperate situation revenue-wise. For us, it allows us to continue to value property this year as well. But yeah, that's definitely not the end of the discussion.
Is there something your office needs to pursue option 3?
No, that's something that our information tells us. There are internal factors in that cost model that will allow us to maintain the values we have now, to where when we roll values to Jennifer, if not for this meeting and the emails associated with it, she would have no idea that something was different at all. I mean, we can make this totally benign. It's just when the apartment owners who pushed hard for this don't get the expected result, they're going to file appeals, and we're just concerned that ultimately we might not be successful in defending what we've done.
Resources to respond to.
No. Not, I mean, sure, we do. I mean, we have, but the way we were going to respond to them might not be a level of, depending on how many there are and the types of arguments made, we might not have the resources to litigate that effectively. Like Matt said, we don't even have a litigation team. I mean, we don't have attorneys, or it's just in-house.
So you might need some more attorney money.
Potentially, yeah.
Because if option 3 is quashed, then we're going to have to go option 1.
I mean, I think we would get basically a written determination from the Indiana Board of Tax Review or the Indiana Tax Court or the Supreme, wherever far it got, and they would pretty much tell us where our arguments fell short, and that's the worst case scenario, is we could have realized that like inflating the grades was not valid, and now for all these appeals, we're kind of stuck tanking them to where we didn't want to tank them today, doing that in 2 years, and then, but I think the idea is not so much getting more lawyers or more money to litigate. To me, it's not a matter of like financial resources at this point. It's just trying to think of what I know about this process and the internal factors that the tools we do have. I don't know that we're going to be able to defend these as market decisions, or that we're going to be able to defend them in the context of, it's the state's cost table. So really, a lot of it gets down to, I think, what they publish about it.
It'll go back to St. John's, so 3, and then if that doesn't work, it goes to St. John's, litigate, if people are unhappy enough to raise.
Quite possibly, we're right back in this room with a similar group of people being like, all right, group, here's the decision from the judge. Option 3 is not an option. Here's the options we do have today. And it could be a totally different set of options at that time, like who knows. But Scott?
What's the state obligation to update for cost savings?
I don't know. Like their legal obligation, it's very bizarre because like up until now, they've given us tools that have been inadequate and told us we don't necessarily have to use them. It doesn't seem like they're obligated to, it seems like the local assessor is obligated to use the sales to determine market value, whether you want to use their cost as a base or not. The big change today is you have to use their cost. So in the past, it hasn't really been an issue as like, how come we can't use your stuff verbatim? Because it hasn't, their cost table since the St. John case, at least in writing, on paper, has not been the basis of value. It's the sales disclosure database, even though I tried to present information that for many counties, it is still very much their cost table. But they're going to hide behind, you collect all the sales, you know what things are selling for, you derive the market value, and our cost can be used as a base. But we are not, their cost, they claim, is not determinative of value. That's on us. So I don't think they are obligated to tell us what, give us the tool or tell us what the market value is. I think it's on us. And again, this law, as much as I disagree with it and as much as I wish the DLGF would implement one of many common sense fail-safes to prevent its impact and put us in a much better spot, I don't think they're to blame. I don't think it's their fault. They didn't make the law. I think they're doing a poor job reacting to it, but I don't think that, you know, I think it's as Matt said, a GA problem and, or a GA fault. What else, guys? Well, thank you for those of you who pushed me over to option 3. I think we would have needed a lot more fiscal analysis to go with something like option 2. Option 1 kind of seems like sits really badly with me, which is why we had option 2 in the first place. So yeah, I think we'll be okay averting a financial catastrophe with respect to rolling values that are pretty close to what we feel is market, pretty close to what we've been doing in previous years. And like I said, if you weren't at this meeting, you might not even know, but it requires us to really challenge the new laws and what factors are appropriate in this cost table that we don't maintain or control. And so there's just going to be a lot of question marks moving forward. And if any of you today have any avenues to explore discussions with members of the GA about what their intent was or if there is a way to readdress this, I would love to have those conversations. Or for those of you who just have questions and concerns you want to address with me or my staff individually, we'll stick around here for a while. For those of you who want to talk, yeah.
You mentioned it to the local legislators. Did you get the sense that, you talked about the 11th hour of a line going in, perhaps some legislators, even legislators, didn't exactly understand what went in? Is that possible?
Oh, very possible. I would be very surprised if most legislators that I've talked to aren't really familiar with the nuts and bolts of the assessment process. So putting a line about a specific table that they would have no experience with.
This option 3 really gives time for the lobbying. It could be very solid opportunity.
Yeah. Yeah. I think what we were looking for option 3 was, is there some sort of buy-in and with the community caring enough to try to put us in a situation by the time these gets litigated that these discussions have happened. And maybe at that point, this will only be for this year because something's been changed moving forward. Or maybe even that provision was retroactive and these cases are moot because they've changed something. So that would be the ideal scenario 3 for us. Well, I see a lot of you guys want to get out of here. Please don't stay. I think we covered what we got to cover. Like I said, I'll be around to talk if anyone wants to stick around for a while.
Thank you for making this work. Yeah.
Hey, thank everyone here and on YouTube. Appreciate it, guys.